first on the macro side, I mean, the Monday meltdown, it was all about the Delta variant and economy shut down. And wait a minute, now we're higher, but the Delta variant's still around. What do you think is going on? What happened Monday?
You know, Brian, I think there was really simplistically, we've seen a very big move up in 10-year bond yields earlier in the year. It probably went too far. And what we've really seen is just sort of a correction right back to this now rising 200-day moving average. But that kind of initial sell-off kind of caused a lot of concerns with people. But again, the kind of narrative that's floating around the market is sort of peak everything for a lot of people. We continually hear that from a lot of folks. Is this going to be peak earnings, peak GDP, peak CPI, et cetera, et cetera? And so that has led to some concerns. And then you layer into that the Delta variant, as you had mentioned, and is that going to lead to not necessarily shutdowns, but delays in terms of really getting these supply chains up and running again? You know, and keep in mind, this is a market, Brian, that's been making new highs every 3.5 days this year. So we're on a record pace similar to where you were in 1995. And I think a lot of people are kind of looking around and saying, does it get a lot better than where we're at right now?
Okay, you may have just given us a future RBI, Craig. I mean, we just like to steal people's stuff anyway. The market is making new highs every 3.5 days. So we're grinding higher. Is it peak everything? Do you think the market has any more room to run?
Well, Brian, you know, we established a 46.25 year-end objective, so we got maybe about 6% more to go. But what's really interesting about this market right now is when you look at the popular averages, the MAG stocks, Microsoft, Apple, Amazon, and Google, they represent about 20% of this market. They've been really very well-performing stocks, and technically they still look constructive in terms of the charts. But what's interesting is when you start looking underneath the surface, and yes, the market has rebounded over the last couple days in here, the internals of this market truly peaked back in February. You made 293 highs inside of our work in mid-February. As of this week, you're down to single-digit readings. If you look at our MACE model, which looks at how many stocks are in any form of an uptrend, Brian, you got like 40% of the market in any form of an uptrend. Okay, so for a market that's making all-time new highs every 3.5 days, and you got this sort of waning participation, to me, this is a sign that the die is kind of getting cast for some sort of deeper correction. And I honestly thought that would have actually started on Monday. And this looks like an interesting rebound. But the levels we need to watch on the S&P 500, we need to watch that 50-day moving average and that uptrend support line. That is exactly the level that we bounced off of, and put that in terms of the Russell 2000, that's at 2130. Any sort of break below those, and that's going to be something we need to watch very carefully.
Yesterday, Guggenheim Scott Minerd, who's been right on the mark about crypto and 10-year yield, said he thought that a 15% stock correction could happen. It sounds like you would not be surprised if we got the same thing.
I would not be surprised at all. In fact, if we were to sort of correct back toward the 200-day moving average, that would get you about another 10%, 11% from where we are right here. And nobody really knows the extent of the challenge that we could be facing with the Delta variant or other variants with COVID. And if we do see some of those challenges, my initial mindset would be, why wouldn't we trade back to the highs we were pre-pandemic, given the very sharp advance that we've seen in this marketplace? Now, there's still things to be done, Brian. Like, we still need to make recommendations to clients, and we still think we need to be overweight basic materials. We need to be overweight the consumer cyclicals and the financial sector. But we also want to be underweight utilities, staples, we continue, and also healthcare, as we continue to see a lot of divergences in those charts and in weak relative performance. So there's still things to always be done.
Yeah, a little contrarian view there on utilities. I know a lot of people like them. You obviously don't. On the consumer side, reading your always must-read research, though, you know, even with all the COVID variants and concerns out there, you still like some of the big names. By the way, one of the stores that was mandated to be open during the peak of the lockdowns, Costco, as well as all of our kids getting out there and playing sports, Dick's Sporting Goods.
Absolutely, Brian. Costco is trending very well on the charts. And if we think about food inflation, and prices for everything really going up, and they say that there's no inflation, but costs for everything are going up, and some of that could be supply chain related. But certainly Costco is going to be, I think, a spot that a lot of shoppers are going to be going to, looking for a little bit of a deal. And then if we also think about perhaps shifting work schedules for people in this new kind of post COVID world, I think a lot more sports and a lot more entertainment are going to be taking place, and charts like Dick's still look very constructive at this point in time.
Shepard Smith here. Thanks for watching CNBC on YouTube.